What are some strategies, some financial planning strategies that you can implement to ensure that you transfer wealth in a more tax efficient way? I've got 4 ideas, that and more, coming up. My name's Mike Bernard, I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. It's being called the Great Wealth Transfer over the next couple of decades. Guys, trillions, tens of trillions of dollars are set to pass from one generation to another here in the United States. And the big idea, if you think about it, the biggest expense you're going to pay in your lifetime is taxes. And so with this transition, how can you do so in the most tax efficient way possible so that Uncle Sam doesn't go in and grab a chunk of that wealth transfer where it matters most, where it matters to you? And so what are some tax efficient strategies for transferring wealth? Well, before we get into 4 ideas, which I've got for you today, I want to specify what I mean by tax efficiency when you're talking about transferring wealth. It could actually mean a couple of different things. The first thought could be, well, inheritance taxes. And at a federal level, that's called the federal estate tax. Well, right now, and under current laws, one person can inherit over $13 million from someone else and still avoid federal estate tax or the federal sort of inheritance tax. Over $13 million. And by the way, if they were married and the individual and they're now a widow, and the spouse that passed away, they didn't gift anything, well then they can share that $13 million and give it to someone else, so $26 million. So for most people, you are not going to have an estate tax issue under current laws. Now, tax laws are set to sunset at the end of 2025, and this could revert back to where it was, but where it was in 2017 was $5 million, just a little bit over $5 million. And again, with that sharing, it's $10 million per family. And again, now that would mean more families are subject to federal estate tax, and you're going to want to work with your CFP if you're near or around that level to do some planning there. But for most people, what I want to share today is talking about how you can transfer wealth from an income tax standpoint efficiently, okay? So it helps being to manage or mitigate or avoid income taxes. What are the ways that you can transfer your wealth in a more tax efficient, income tax efficient way? I've got 4 ideas. The first one, have as much of that money, have as much as your wealth in Roth accounts as possible. This would mean contributing to Roth IRAs. This would be strategically doing Roth conversions where you're shifting money from pre-tax accounts over to your Roth. And when you do that Roth conversion, it's taxable in that year. But here's the reasons why you would. If you're in a situation where you're looking at your tax picture today saying, you know what? I'm in the 12% tax bracket, or I'm in the 22% tax bracket today. And if I pass away, or as this continues to grow, when my family inherits it, they could be in a much larger tax situation, much higher tax bracket, because maybe tax brackets have changed, or maybe their income's at a higher level, or if they're required to withdraw, under current rules, inherited retirement accounts all within 10 years. If it's pre-tax and they've got to take that much out within 10 years, it's going to push them into paying higher taxes. Having as much of your wealth structured in Roth accounts is going to be the most efficient way to transfer wealth in a tax-free way. Why? Because you've already paid the tax, and all of the growth on that is going to be tax-free, both to you if you draw those dollars out during your lifetime, but also to your heirs if they inherit it. Yeah, they would have 10 years to withdraw the account, so they won't be able to keep the account growing tax-free for the rest of their life. They'll have to withdraw it, but as they inherit it, as they withdraw it, there will be no income taxes because it's structured in a Roth account. So we see this all the time in retirement, especially second half of retirement, where folks are looking and saying, well, my financial situation is such that I'm not paying a lot of tax. I'm in the 22% tax bracket, or maybe I'm in the 12. And guys, sometimes we see this where now I'm not paying any taxes, but I've got this IRA account that's $500,000 or something that at some point when I pass away, the kids are going to inherit it because we're not even touching it right now. So odds are they're going to inherit it. And when they do, they're going to have to pay tax on it. Those are opportunities where you need to work with a CFP and explore, well, should you do Roth conversions? And if so, how much to get those dollars into a type of account where they can be transferred or inherited in a much more tax efficient way. So that's the first idea. Second idea, and by the way, ideas 2 and 3, they are connected, but second idea is have a giving strategy, have a gifting strategy. So most people, this is one of the most common questions that we get, will ask, well, how much can I give someone else without it being taxable? Well, that answer, there's the annual gift tax exclusion. The IRS publishes that amount every single year. Sometimes it stays the same, sometimes it's different. $18,000 per year. One person can give to another person without it being taxable. Now, if it's money coming out of an IRA, then withdrawing from an IRA, that's taxable. But if you've got cash in the bank or you've already drawn maybe from your IRA, a required minimum distribution, something like that, and you want to give it to the next generation, you can give $18,000 per person per year, and you don't even need to report it. It's not taxable, and you don't even need to report it. If you're married or the person you're giving the money to is married, you can do gift splitting. So if, say you're married, you can give $18,000 to your child, and your spouse can give $18,000 to your child. That's a total of $36,000. And if your child's married, you each can give 36, or you each can give 18, and to their spouse, you each can give 18. So $72,000 can transfer without any tax or any worry or anything like that. So what's your strategy? And why would I bring this up as it relates to a tax efficient transfer? Well, if you've got dollars that are currently growing and earning interest and impacting your tax return, but you've done your financial plan and you're saying, we're not going to need these dollars. Financially, we don't need these dollars for in our lifetime. Maybe you consider a gifting strategy so that you're giving those to your kids, some of those dollars to your kids, and they position them into their Roth 401k or Roth IRA. Basically, giving them resources to make sure that they're maximizing funding their accounts that are going to be tax sheltered and grow tax free for the rest of their life. That could be part of your gifting strategy, but then the other part of your gifting strategy could be if you have any desire to donate dollars or resources to charity. Then when you're looking at all of your financial assets, and some of them are in certain, in an IRA, some in a Roth, maybe some have some in real estate, something like that. Considering, instead of looking at, well, I want to contribute 5% of my total net worth or 10% of my total net worth, maybe looking at, I want to contribute the bulk of that out of my IRA. Because if you donate to charity from your IRA, then the rest of the resources are there to be passed to the next generation. It's going to tie into to point number 3. But the church or the charity, when they receive the IRA, they're not going to have to pay tax on it. Where if you would have left everything proportionate, a slice goes to church, everything else goes to family, then the family would be paying tax as they withdraw from that IRA. So having a strategy where you look at different assets, different resources, and if you're charitably inclined, directing certain of those dollars to go to pass to nonprofits. That's another way of having a more tax efficient transition of your wealth. Anytime you talk about giving, though, it leads to this very next issue, and that's sort of the third concept or third approach to making your wealth transfer more tax efficient, and that is use the step up in cost basis. Use that step up in cost basis. What does that mean? Well, if you own, let's say, your house, okay, and you paid $200,000 for your house, but the day you pass away, it's worth $500,000. Well, if you were to give your house to your kids, and we hear this a lot, well, I'm getting older in age and maybe I'm even living in assisted living. Should I give my house away to my kids? If you do that, you're giving them the cost basis, $200,000, even though the value's $500,000. And so when your kids sell the house, they will have to report that capital gain, the difference between the cost basis and what they sold it for. Now, if one of the kids lives in it for 2 out of the last 5 years, they could qualify for the exemption in this instance. But when you are giving assets that are not within a tax shelter, you're giving your cost basis. Versus If you hold that asset until you pass away, then your kids or your heirs are receiving a step up in cost basis and avoiding having to pay the capital gains tax or having to report those capital gains on their tax returns. In this same example, instead of you giving the kids your house while you're still alive, if they inherit it when you pass away and then they sell it, their cost basis, instead of yours being at 200, it was stepped up to the value that the house was at when you passed away. So $500,000, they sell it at $500,000, there's now no gain that they would need to report. Oftentimes, as people are reaching that stage of life where they're seeing, I don't think we're going to use all this money, that gifting strategy morphs into, I shouldn't have assets and let me just give everything away. Well, you need to be careful when doing that because you could be giving away this potential step up in cost basis and instead giving a tax liability when you inadvertently don't want to do that. So having a gifting strategy, that's the second idea, but maximizing your step up in cost basis, that's the third idea. And then finally, idea number 4 to transfer more wealth tax efficiently is consider leveraging life insurance. Now you need to be careful because when you're looking at all 6 areas of your financial life, protection planning is one of them, does it make sense for you to have life insurance? Many people have a temporary need with life insurance and therefore you want to have temporary insurance or term. But if your goal is to leave an inheritance, leave a legacy, then considering using a different type of life insurance policy structured to do just that may make sense, especially if your goal is to transition wealth in a tax-free way. Why? Is life insurance taxable when you pass away, when you receive the death benefit? Most oftentimes it's not. Most types of policies, no. You can inherit, you receive the life insurance death benefit and it is income tax-free. Not all. In rare situations, types of policies, it could be taxable, but most situations it isn't. Therefore, if you're looking at your overall financial situation and one of your goals is to transition wealth to the next generation and do so in a tax-free manner, consider, well, what role will life insurance or should life insurance play in that? One creative example, creative strategy, say you've got $1 million in an IRA and you've reached a point where you're forced to take required minimum distributions, but you don't need those resources because you've built up assets elsewhere. And you're looking at this $1 million IRA, and not only are you forced to take withdrawals that are taxable, when you pass away, your kids or family members are going to inherit that $1 million, and they're going to have to withdraw it all within 10 years, and they're going to have to pay tax on it. Is there a different way? Well, what if you bought $1 million life insurance policy? How would you pay for it? What if you use your required minimum distribution out of that IRA that you're forced to take, and that helped pay into this life insurance policy? Then when the kids inherit the life insurance policy, $1 million, they receive that tax-free. The IRA, hopefully there's still some resources there, but that has been essentially used and transitioned into this tax-free wealth transfer tool of life insurance. That approach, that planning idea does not make sense for most people or for all, and it might not make sense for most people or all to have life insurance as part of their wealth transfer, but work with your CFP, see if that makes sense for you. All right, so those are just 4 ideas on ways that you can transition your wealth to the next generation in a tax-efficient way during your life, but certainly as you look at leaving a legacy, you need to be doing proactive tax planning. Work with your certified financial planner on these strategies, which ones to implement, which ones to avoid, and any others. And if you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.